Thank you, Neve, and thank you all for being here tonight. This is going to be a very interesting discussion. Even considering the fact that we had a lot of excitement this week with the Dow Jones crossing the $15,000 level and closing over 15,000, it's really difficult to forget the lasting impact that the global financial crisis has had on all of us. And particularly the topic tonight, it's on the wave of financial regulation and reform that followed that crisis. Dodd-Frank, Basel III, other reform initiatives sought to mitigate systemic risk and promote transparency in the global financial markets. But they also created, at the same time, vibrant debates about the effectiveness of global financial regulation. Topics such as too big to fail financial institutions, capital requirements, subsidies, competitiveness. And these debates are still going on. They're alive and well. They're in the media every day. They're in the discussion among people in the industry every day. As evidenced by the number of people we have here tonight, there's enormous interest in this. Some of these topics are divisive, but they're clearly all complex. Well, we have assembled a terrific panel tonight to help us walk through these issues, and I just want to take a brief opportunity to introduce them. You have material about them, so I won't go into a great deal of detail, but we have Tom Braithwaite, who's the U.S. banking editor of Financial Times. He leads their U.S. financial services team. Previously, he served as the Washington-based business and politics correspondent. He focused on financial policy and regulatory reform. We were supposed to have Pupulinda Gill here tonight, who heads the CME. Unfortunately, he had to undergo rotator cuff surgery yesterday, so he was not able to be with us tonight. But Brian Durkin, who's the Chief Operating Officer of the CME Group, is with us tonight. And as part of his responsibilities, he led the integration following the CME's merger with the Chicago Board of Trade and then their subsequent acquisition of the Mercantile Exchange. So we're delighted that Brian can be here with us tonight. Simon Johnson is the Ronald Kurtz Professor of Entrepreneurship at MIT. He also is a senior fellow at the Peterson Institute in Washington and a member of the FDIC's Systemic Resolution Advisory Committee, a topic I'm sure we will get into tonight. Previously, he served as chief economist at the International Monetary Fund, and actually Simon was here on the council platform 3 years ago, so we're delighted he's back. And Bill Rutledge is with us. Bill is now managing director of Promontory Financial Group, but prior to joining Promontory, he was the executive VP for bank supervision at the Federal Reserve Bank of New York. And as many of you know, there's a very large number of large banks in New York, and Bill was responsible for leading the group that supervised them, and he's clearly one of our nation's experts in the area of supervision. So the format tonight that will follow is each panelist has agreed to speak for 8 to 10 minutes, sort of framing their remarks, help outline their perspective, and then I'll moderate a discussion up here, and we'll then move into Q&A in the audience. So with that, Tom, why don't you get us started?
Thank you very much, Michael. Thank you all for this brief opportunity. I'm going to speak for probably less than 8 minutes, and I'm going to speak to you about a spandex-clad roller skating dominatrix, Paul Volcker and Jamie Dimon. Sadly, they weren't all in the same room at the same time, and it isn't a joke. These are 3 people I've spent some time with recently, and they all have something to say about this debate over whether banks are too big to fail. The roller skating dominatrix was outside Citigroup's annual meeting in New York a couple of weeks ago with a sign that said, "Bankers need a spanking." And after I referred to her in the FT, she kindly sent me an email with some other pictures in other outfits that she does at these events around the country. The whole Occupy Wall Street movement has fizzled, and it never appeared particularly big or significant, but I think that belies the fact that up and down the country there is still a great amount of public anger that, for example, no senior financial executive has gone to jail for some whatever crimes they think they've committed during the crisis. And meanwhile, of course, the largest banks have got larger. JP Morgan Chase did swallow two other failing institutions. And smaller community banks are furiously lobbying Congress, saying that the playing field is unfair. The biggest banks need to be broken up, or at least to be given punitive levels of capital. It's interesting to me, because I was in Washington throughout the whole Dodd-Frank process, that the pendulum was supposed to be swinging back towards the industry by now, and that seems to have what's happened over the last several decades. Paul Volcker seems to have interrupted this process at least twice, to my calculation. The first was in January 2010, when Dodd-Frank was almost completed, and yet in some response to mounting public anger, the president dusted off the famous former Federal Reserve chairman and said he was naming the Volcker rule after him to impose tougher restrictions on proprietary trading at banks. And this was later added to the Dodd-Frank law, became law. And the second instance that I thought was notable was when two news organizations, you're all Financial Times readers, so you don't look at them regularly, but the Wall Street Journal and Bloomberg, in this case, wrote a story about something called the London Whale, which proved to be a JP Morgan trader taking massive and rather unfortunately horrible bets on credit derivatives. That then has pushed the pendulum again towards tougher restrictions on the banks. I think the interesting thing from my point of view is, what does the center ground think? Not what does the roller skater think, and not what does Jamie Dimon think, but what do people in the Fed think? And from conversations with them and others, it appears that there is a desire from moderates to go further, either to increase capital charges so that banks become less risky still and less profitable still, by the way, or for some other form of breakup or other action. So I would just like to say I think that is the thing we should be watching for. Are the sensible men in suits in Washington and New York and Chicago, and women when you find them at the Fed, which to be fair you do in some senior positions, are they going to want to go further? And perhaps some of my other colleagues will discuss that later. Thank you very much.
So as you can see, we're going to work down the panel here. So Bill Rutledge is next.
So we shifted away from alphabetical order for some reason. So I do want to thank Michael for his kind introduction and for inviting me here today. It's really nice to be back in Chicago and to be on such a high-powered panel to talk about a very challenging and fascinating topic. The financial crisis has certainly brought to the fore a whole series of interrelated issues, things like too big to fail, too big to manage, and tonight's topic, which is particularly near and dear to my heart, too big to regulate. I'm sure you're going to hear the panelists all come at these issues from slightly different perspectives. We have different backgrounds and approaches to issues. So I think you'll hear a lot of good thoughts on what has been done and what should be done. But I think at the center of the whole debate can be a very strong question, and that is, should the largest financial institutions be broken up? Or alternatively, should efforts continue to be focused on improving the regulatory structure to address the shortcomings that were evident during the crisis. I'm in the latter camp of believing that the better public policy approach is to use the lessons learned from the crisis to address the admittedly wide range of legal, regulatory, and supervisory issues. As Michael suggested, I was at the center of front lines at the New York Fed during the crisis, so my perspective is, I'm sure, heavily colored by that experience, particularly as we fought to try to keep the system from collapse during the darkest days of 2008. Tonight, I will, of course, not be speaking on behalf of the Fed, or for that matter, Promontory Financial Group, where I've been the last couple of years. But reflecting back on my time at the Fed, particularly the last several years, it's very hard to argue that the U.S. financial firms overall were effectively regulated pre-crisis. I'm going to tick off a handful of major problems in something of a top-down way, beginning with legislation, then going to regulation, and then getting into supervision. Beginning with the legal and institutional structure, it's in some ways shocking ex post that the U.S. allowed large categories of major financial firms to escape effective consolidated supervision, including a number of firms which were at the center of the crisis, AIG, Lehman, and Bayer, for example. The Europeans raised this issue well in advance of the crisis, but ultimately accepted that the investment banks were subject to consolidated supervision by the SEC through a rather creative, but I think fundamentally flawed regime called the CSE regime. Similarly, major financial conglomerates like AIG were accepted as being supervised on a consolidated basis by the OTS, the thrift supervisor, not to mention the regulatory structure that was then applicable to Fannie and Freddie. Also on the legal side, no special resolution regime existed at the holding company level, even though that was the form of organization of most major financial firms. That is, the FDIC could and did resolve insured DIs, but no regime other than general bankruptcy existed for bank or securities holding companies. Despite the huge problems that even an expedited bankruptcy process would present, as volatile liabilities hemorrhage out, destroying remaining business value. Adding considerably to those issues and challenges was the global context in which resolution would have to proceed. Additionally, the regulatory capital regime was in a slow transition process toward a more risk-sensitive structure. And that prospective new regime exhibited numerous flaws in risk capture, capital definition, and required capital levels. And the international regulatory forums had not yet focused effectively on liquidity issues, leaving liquidity as an issue to focus on after addressing capital. As we all know, liquidity was central to much of the crisis. Finally, on the supervisory side, there were fundamental issues in various dimensions, many of which centered on not recognizing the potential for very significant downside risk, particularly given how complex and untested many business strategies of major firms were. For example, stress testing requirements were not nearly as strong as they should have been. Relatedly, as the crisis began, supervisors and regulators did not immediately force banks to curtail capital distributions. I'm sure each of the panelists will get into how some of these issues have been addressed through Dodd-Frank and subsequent to Dodd-Frank. My view is the system has been moving generally in the right direction, but the pace of progress has been slow, and some of the action steps taken have had their flaws, such as, in my view, the complexity of the draft regulation to implement the Volcker rule that Michael alluded to. The ultimate question is, Even giving credit for potential progress in these dimensions, can major firms be regulated effectively, or must they be broken up? The idea of breaking up the major financial organizations brings with it an array of questions that need to be addressed. What should the standards be? How big is too big? How complex is too complex? How interconnected is too interconnected? What are the implications for product delivery capacity and scale economies? What would be the effects on the division between the regulated sector and the unregulated sector? What would be the effect on global competitiveness, as breakup decisions would not likely be consistent across countries? And how disruptive would the act of breakup be? The phrase that Fed Governor Jeremy Stein recently used of leaning against size, complexity, and interconnectedness makes more sense to me, particularly if the effect of resulting policy actions to do such leaning is to improve regulation and supervision in some of the areas I mentioned. His central argument for a tax on systemic importance, as opposed to, say, a quantitative size limit, I think is a much better way to go. There are various reasons to prefer it, including it would be practically difficult to rectify a decision to break up banks if you don't like the financial reality after they've been broken up, whereas you can modulate a taxation approach over time. I think there are many avenues regulators should consider to encourage firms to reduce their systemic footprint and improve the supervisory and regulatory process, such as capital surcharges, debt requirements at the holding company level to facilitate resolution, disincentives to fund assets with volatile non-deposit liabilities, more exacting and firm-specific capital and liquidity stress testing expectations, much more critical product approval reviews of capital markets activities in particular, and limiting acquisitions by firms that are already deemed to be globally systemically important. Thank you very much, and I look forward to the give and take with the audience and with my fellow panelists.
Thank you. Thanks very much for the opportunity to be here today. I agree with Tom that the key issue right now, the policy issue, is what will the Fed do? The 4 men and 3 women who sit on the Board of Governors of the Federal Reserve System, they have the ability to make decisions that will move us in a safer direction or a more dangerous direction with regard to our financial system. And I also agree with Bill that the key issue is, should the Federal Reserve, wait for the implementation of Dodd-Frank and working through all of those implications, or should it take additional steps, for example, including breaking up the largest financial institutions? My position is, like it or not, the largest financial institutions in this country will break up. They will become smaller. And to convince you of that, I need to persuade you to change your understanding of 3 words: banks, risk, and capital. It's commonly said that the largest 6 financial institutions, highly leveraged institutions that we've already started discussing, are banks. And you know what a bank is. A bank takes deposit, a bank makes loans. Sometimes this goes well, sometimes this goes badly. 5 of the 6 largest institutions in this country, the institutions in question, are not banks, not by any traditional, standard, reasonable definition. They are large, complex, cross-border, speculative trading houses. They're also completely opaque. You have no idea what they do exactly, how they make the money, and where the risks really are. And I say that with confidence because I see that Jamie Dimon is not in the room. Oh, I'm sorry, Jamie Dimon after the London Whale, I should make a correction. It's not clear that Jamie quite has the grip on risk and how these conglomerate structures work that he used to have. Nobody knows. There's certainly nobody who follows the public reporting knows. Perhaps people who've had access to the supervisory information know. Judging from their track record, judging from the mismanagement of the supervision, for example, of institutions that were subject to comprehensive integrated supervision, such as Citigroup, I don't think they know what's going on. Citigroup, of course, has failed 3 times in the last 30 years. This is an agreed narrative that I have with former Citigroup executives. Failed in 1982 on the back of emerging market loans, late 1980s on the back of bad loans to commercial real estate, and just now due to complete mismanagement of risk around residential mortgages. Citigroup is going to fail again. That I think is self-evident. The question is, when it fails next time, do you want it to be bigger or smaller? What do they want? How do they think about risk at Citigroup or another one of these large speculative trading houses? They are too big to fail. They're also too systemically important, too interconnected. We can argue about the words. They would not be allowed to fail. Well, actually, let me turn around. Let me ask you. I asked this audience 3 years ago. I ask every audience, everywhere in the country and everywhere in the world that I speak, the same question. Today's a Thursday. Thursday is actually quite a good day for banks to fail. The Clearinghouse did a simulation of bank failure recently. Number 1 recommendation was don't fail on a Tuesday. Very helpful, that one. Too long from a Tuesday to the weekend. But this is a Thursday. Pretty good day. You just got to bridge it until the markets close on Friday afternoon. JP Morgan Chase is the largest bank, speculative trading house, in the world, measured correctly, on a comparable apples-to-apples basis. Has a balance sheet using international accounting standards of around $4 trillion. It's opaque. You don't know where those connections reach. You don't know who's holding their debt. You don't know what the knock-on effect would be. You saw what happened when Lehman Brothers went down, $600 billion balance sheet and a lot of interconnections in September 2008. If JP Morgan were in trouble today and on the brink of failure, who here thinks they'd be allowed to collapse unimpeded by any kind of government rescue or bailout or Federal Reserve support, all of which has become somewhat more complicated as a result of Dodd-Frank? Who thinks that JP Morgan could fail? I see no hands. It couldn't fail. It wouldn't be allowed to fail. It would be rescued one way or another. You know that. They know that. The credit markets know that. What is risk in that situation? Risk is good for the people running JP Morgan or other large leveraged financial institutions. Take a lot of risk, get the upside, and when bad things happen, it's not your problem. Someone else bears the brunt of the downside, either through direct bailout or in terms of the massive, calamitous, negative consequences for the real economy. So we should have, according to Dodd-Frank, according to the Basel agreements, more capital in our financial system, in these large banks. What is capital? Well, I'll tell you what capital's not. Capital is not something that a financial institution holds. When you hear that verb, hold, in the context of capital, you should understand that you are being misinformed. Capital is a synonym in this context for equity. Equity is not on the asset side of the balance sheet of the banks, it's on the liability side. You fund yourself with equity. Higher capital requirements do not mean contrary to a widely held perception, reinforced daily by the media, not the Financial Times, I'm sure, but many of their competitors. Somehow higher capital requirements mean the banks are going to be, quote unquote, holding more capital, not able to support the real economy, not able to make loans. On the contrary, higher capital requirements mean more equity funding, a larger buffer that can potentially absorb losses, make the largest banks safer, make the equity safer, and make the debt safer. That's the point. Suspend dividends, suspend share buybacks, build up the equity on the balance sheet of the largest banks. This is the safest, smartest way to make any financial system safer, not just in the United States, after any financial crisis. And I've worked in many such crises around the world over 25 years. What did the Federal Reserve do? Did they suspend dividends? No. Did they allow share backs? Absolutely. The people running the Federal Reserve, the Board of Governors, have let you down repeatedly, both in the run-up to the crisis, 2008, and subsequently. If equity builds up on the balance sheet of these speculative trading houses, it's not taking anything from the shareholders at all. It still belongs to the shareholders. Financial executives will tell you they need to make a 10% required return on equity. They're telling you, actually Martin Wolf makes this point, one of Tom's colleagues at the Financial Times, a must-read commentator on these issues. The banks, the financial houses are telling you with that statement that they're very risky. Risk-free rate is less than 1%. They need 10%. Why do they need this high rate of return? Because they're very risky. That's good for them. They like the risk. They get the upside. The risk at this level is bad for you. And the reason they'll break up is simple. They have an incentive in this situation with this unfortunate attitude from the Federal Reserve. They have an incentive to do it again, to behave not just as JP Morgan did with the London Whale, HSBC and Standard Chartered on money laundering, the involvement of all these major institutions on LIBOR fixing. Many of the other, let's say, market manipulations, as a shorthand, come exactly from this kind of incentive structure. These financial institutions are designed by themselves with deliberate consideration to do exactly this, to pay out for the insiders very well over the next 1, 3, 7 years. The downside, the costs, will be for you as shareholders, as bondholders, as taxpayers, and as citizens who will confront another huge financial crisis. Thank you very much.
Well, after listening to all of this, it sounds like all is bleak, and I'm here to try to change that dynamic a bit. Yes, we're coming out of the turmoil of 2008, a situation which, we hope we as an industry and as a global marketplace never experience again. And just to give a little bit of a backdrop as to who I represent and how we feel very strongly that we can help prevent future situations like that which occurred. The CME Group is well known for being a futures derivatives exchange. We're accessible to over 150 countries throughout the world. We trade on an average daily basis of approximately 13 million contracts a day, covering asset classes including U.S. Treasuries, Eurodollars, other interest rate products, foreign currencies, energy futures and options, all agricultural products, equity indices, metals, representing open interests of about 84 million contracts. Put that in perspective, we've had numbers thrown around of $1 quadrillion or thereabouts a year that flows through our system of trading and clearing. Associated with our business and a fundamental premise of our business is the clearing facilities that we offer and represent. So through our central counterparty clearing services provided through our organization, we're able to guarantee every transaction that comes through the CME Group. We mark every one of those positions to the market. We know exactly where the risk stands with everyone that clears business through our institution. And we're a highly regulated organization and have been since our inception. We've been in existence for over 150 years. Through the futures regulatory regime, we do have very, very high standards of integrity, very high standards of transparency, very high standards of centralized information and information that is well publicized and communicated to a marketplace. And I think what we're experiencing today is the other side of that equation, the largely unregulated OTC market, is now finding itself in a position of being highly regulated in the context of business that was largely executed in a fairly opaque environment is now migrating itself towards more transparency. And I don't think anybody on this panel or in this room would disagree that that's a movement in an appropriate direction. So, where are we in the context of that migration? From the CME Group's perspective, we've taken that model and we've extended ourselves to the clearing of these OTC transactions. And clearing of OTC transactions is not a new business for us. We've been doing it for over a decade. And we've been expanding ourselves beyond the traditional asset classes for which we provision those services and energy to agricultural products, interest rate products, and credit default swaps. The Dodd-Frank regulations, I assure you, are well in place. The market is moving in that direction towards a centralized cleared model. As this marketplace is going through a major paradigm shift, and it is a major paradigm shift, it's incumbent upon all of us to take the laws and the regulations that have been put in place and to provide the education and the support for that business that we're all talking about to effectively transition under this new regime. And we're very happy to say that there's already phase one of that implementation has already occurred. It occurred back in March. And so the CFTC has effectuated, through the enactment of Dodd-Frank, its rules and has phased in the implementation of mandatory clearing for interest rate swaps and credit default swaps. And we're aggressively working very closely with the community to help them through that transition. But as we're moving through that change of dynamics, I don't think any of us should lose sight of the perspective that as you're going through a major transition of this nature, you also need to be mindful of maintaining the effectiveness and the efficiency of the business that has been supported in that regard. There is a basis for the business that we're talking about. And it serves in some way, shape, or form all of us to some degree. And so as we're working towards the execution now of this transition to a more transparent, a more standardized way of effectuating that business, we all also need to be mindful of ensuring that the regulatory regime itself comes out in a balanced fashion so that markets can continue to evolve, so that these markets can continue to innovate, and so that we can continue to rely on the various instruments that each of you in some way, shape, or form are relying on in terms of global finance and the ability to effectuate your business needs. So from our perspective, we look at this as the market is shifting in the right direction, and that there has been some well-formulated requirements and standards that have been imposed. And yes, it may have taken longer than many would have liked, but I don't think people should underestimate the complexity of what was taking place here in the context of the definition of what the rules of the road were going to be going forward. The other complexity behind all of this is, and my co-panelists have alluded to this, we're talking about a global marketplace. So as regulations are being effectuated within the U.S., similar regimes are taking effect in other jurisdictions. And it's very crucial as this continues to unfold, because many of these rules have yet to be effectuated, that we watch closely and we work very closely to achieve parity in terms of treatment across jurisdictional borders, because I'm sure we'll probably get into this a little bit in our dialogue, because something may be happening in the U.S., it's probably going to have some impact in other jurisdictions if you're talking about a risk of a default or that type of situation. And so it's another thing for all of us to be thinking about in terms of how the various jurisdictions around us are dealing with this very topic that we're speaking about today. Thank you very much.
Well, there's no shortage of topics to talk about, but let me try to play off sort of what Brian was talking about. You talked about the regulators having to keep up with what's happening. Simon, you were critical of the Fed. Bill, you talked about mistakes that were made earlier. Tom, I don't remember if you talked about this or not, but the markets, the financial markets move quickly, and people who are running financial institutions move quickly as well. These are very bright people involved in these activities, and they move at lightning speed. Can the regulators keep up with these changes? Is it possible that the regulators can keep up with these changes in the markets and the institutions and provide effective regulation? Tom, why don't I start with you?
Well, I think speaking to Wall Street institutions, most of them would say publicly that they love their regulators and they're the brightest people in the universe. But privately, most of them would still say that many of the Federal Reserve supervisors that are embedded in their buildings day by day are well up to the task, and that there have been some doubts about some of the other officials. I mean, it's always going to be an unfair arms race, isn't it? If you've got people paid millions of dollars at the top of Wall Street firms, you're not going to, despite the relatively well-paid examiners at the New York Fed and elsewhere, you're not going to compete in that manner. But there are still plenty of bright people that want to go into that sort of career.
Bill, you were there. What do you think?
Well, obviously it's an incredible challenge for the reasons that Tom alluded to, among others, to recruit, develop, and really utilize highly sophisticated experts in trying to go face-to-face, toe-to-toe with specialist bankers. And one of the things that I did when I became head of bank supervision of the New York Fed was to move to a business model that emphasized specialization for the very reason that was implicit in Michael's question, that if you had a generalist examiner went from a regional bank holding company one day to a community bank the next, and then tried to go into a money center organization, that person didn't stand a chance in even asking the right questions. So we did try to build up specialists in market risk and liquidity risk and credit risk who were asked to really stay up on top of what was going on within their domain and to get some degree of exposure to a cross-section of firms so they would know the state of the art. So for a long period of time, the Fed tried to build up those kinds of specialists who would have at least a fighting chance to understand. I think a major development that happened late in my career and has gone on since I left the Fed is much greater utilization of resources beyond just the field examiners to try to understand complex risk management and risk exposures of financial firms. Much greater reliance on economists, much greater reliance on markets and payments people to try to help fashion an understanding of what kind of stresses could be visited on financial firms and therefore help the micro supervisors to try to come to grips with some of those exposures.
So can they keep up or stay ahead?
Stay ahead is an impossibility. I think with a lot of effort and really good access to information, they can do a decent job of staying with the more complex organizations. I think it's going to be an enormous challenge to do that over time. And I do agree with the thrust of some of Simon's points that, and I suggested that in my remarks as well, that some kind of leaning against complexity and some degree of moving back to more traditional banking does make sense to me. I think the system went too far down the path of complexity, too far down the path of financial risk-taking. So I'd like to see some moderation and some leaning against complexity going forward. That would give, I think, the examiners of the various supervisory agencies a better chance to stay abreast of the risk.
Simon?
I just want to push back a little bit on something Bill said. There's no question the Federal Reserve supervisors try very hard. They're hardworking people. They're doing the best they can. But I would refer everyone to the London Whale report produced by the Senate subcommittee headed by Senator Levin and Senator McCain, Exhibit 46. It's a big report. Just look at Exhibit 46. There's an email from Ina Drew, who was a responsible executive, to the person who runs the risk models in the relevant part of JP Morgan Chase, saying that, to translate into English, into plain English, she says that they want to get a better number on their capital for the stress test being run by the Fed in order to be allowed to do a share buyback and therefore presumably increase the share price. And then the rest of the exhibit is about the complexities of the calculation, but it's just a calculation. It's a modeled game that they're playing to make their capital look better, because it's become this calculation, this particular dimension of the regulation supervision has been trapped by the crazy complexities of, I would say, Basel, and where our international competitors wanted to go. It's a complete blind alley with regard to your question. Regulation works when it's simple, when it's transparent, when everyone can see what you're doing. So that's exactly what happens on well-run exchanges. That's what you need. But if you're talking about regulation within these enormously complex financial institutions, even Ina Drew's own management says they didn't know what was going on, let alone the supervisor and the regulators. And that was just that was not a complete meltdown of JP Morgan. That was a near miss. And from near misses, like the FAA, when they have a near miss on the runway, they don't say, "Oh, good, it was a near miss." They say, "No, wait a minute, what happened here?" And what happened in JP Morgan is exactly the complexity has outstripped the human ability to manage and supervise it in these mega institutions.
So you would say the the management can't keep up, therefore the regulators can't keep up, I guess is what the new complexity.
Well, the management claims they couldn't keep up. It's an interesting question. That is their claim on the record, I guess under oath. And yes, in that case, how could, the board says it couldn't keep up either.
Okay.
It's an interesting question whether the risk committee of JP Morgan knows anything about risk, but that's a different matter. So how can the supervisor keep up in that situation?
Yeah. There are, I'm sure many of you know, the board meeting since we're talking about JP Morgan, is on the 21st of May, and two advisory services have advised to split the role of chairman and CEO, and at least one of them has said to get rid of the risk committee, change the risk committee.
And some members
of the audit committee. And two have said get rid of the audit committee, or change the risk committee. Anyway, Brian, you have a different regulator. Your primary regulator is different, the Commodity Future Trading Commission. So why don't you give us your insights there?
You know, given what they've undertaken, I think the CFTC has done a very solid job dealing with a very complex situation. And there was immense amount of rulemaking that has been undertaken, and a lot of complex issues. Even though you might think they're fairly straightforward, as you get deeply into them, you realize that there are consequential impacts to certain things that you're looking to transform or change. And so with all that said, we have rules in place. There is movement in the right direction in terms of migrating this business to a centrally cleared operation. The one thing that I do worry about a bit is regulatory overreach at times, in terms of maybe going down a path or making things a bit more complicated than they need to be, and as a result, you might be slowing up the progress of implementation of what the direct problem is and getting that issue addressed. And what I'm speaking of is as you start developing regulations to migrate business on the OTC side into a centrally cleared facility, you start seeing rulemaking that's touching into the well-run, well-regulated exchange-traded derivative space, and before you know it, that creates a lot of uncertainty in the marketplace, and so that is an area of some concern that we don't allow ourselves to make things overly complicated or go down paths that were wider than what was intended to begin with.
So Brian, with this move of the over-the-counter derivatives onto centrally cleared exchanges, is there a risk here that we're putting too much into these exchanges and they're getting so big that they in themselves may be, quote, too big to fail?
I can only speak from the veracity of the, I'll call it a well-oiled machine that we've had in place for over 100 years, and that is based upon having very rigorous risk management capabilities, having a very effective mechanism to deal with risks of default, making sure that you have very attentive modules in place in terms of, and requirements in terms of who's bringing that business in, that they meet the financial wherewithal, that they satisfy very rigorous capital requirements, and that by the very mechanism of taking those positions in and forcing them into a model where that risk is managed in a centralized manner, and the clearinghouse becomes the guarantor of every side of that transaction, there's margins associated with that. And those margins are very much pegged to a very historical viewpoint on the risks that we're taking on. And so having that whole model in place, I think reduces concerns of that matter. So we're very comfortable with our capabilities to take that type of business on.
Okay. So let's sort of step back a bit. We had problems with these very large financial institutions. We passed a law, the Dodd-Frank Act, extensive piece of legislation. Are we better off now? Are these large institutions more or less of a problem now for us? Have we made any progress here? Tom?
I'm wary now of being told off by Simon in a minute, but I'll do it anyway. I think we're considerably better off now. And I think the Fed now does these annual stress tests and they say, well, what if the economy fell off a cliff tomorrow and there was 13% unemployment and several other scenarios? What does this bank look like? And if you believe in the stress tests, and I think they've got relatively good reviews of how rigorous they are, then after a crisis as bad as the one we experienced, the biggest banks would be better capitalized at the end of that than they were going into it. Now, Simon would say that's still not high enough, and I'm sure he will in a moment. But and there are plenty of people, moderates within the Fed, as I alluded to, who would agree. But whether we've gone far enough, I'm not going to say. But we're certainly in a more solid position among the biggest institutions.
Bill?
And I would agree with Tom that some degree of progress has been made. You certainly can point to a few institutional or structural changes. I think the creation of FSOC at the core of Dodd-Frank.
FSOC, you better explain.
I'm sorry. The Financial Stability Oversight Council, adding that to the apparatus within the U.S. financial oversight system, I think was a very good step. Prior to Dodd-Frank, what existed was a very informal group called the President's Working Group, where the heads of agencies periodically got together and talked. FSOC has a real mandate. It has a broader set of attendees. I think it started the process of trying to ensure that there aren't this kind of major gaps in coverage as existed pre-2008. It hasn't named any new systemically significant financial firms, although it has named a handful of financial market utilities. Picking up on Brian's point, the FSOC has already designated some in that sphere. And I think on the institutional architectural side, I like the fact that we have now the Orderly Liquidation Authority, or OLA. It's got to really get implemented, though. I think there's been some good thinking done by the FDIC, the Bank of England, and the Fed on how you could structure a resolution regime that really works. Because to some of Simon's opening comments, you want a system that penalizes firms for taking undue risk. You wipe out shareholders, the senior management is gone, and if you put in place a structure where required debt is held at the holding company level, some of that could be haircut as well. So there'd be real penalties taken on in the face of failure of a major firm. So those kinds of architectural developments, I think, are positive. More has to come. And I very much agree with Tom's point on stress testing. Stress testing was, I think, enormously helpful in 2009 when we did the supervisory capital assessment process. I think it played a big role in getting some degree of confidence in the financial system in the U.S. again. And I think the Fed has tried to build upon that with its approach of looking at stress testing across the major organizations. I do think there is a danger in that the emphasis has been so heavily on regulatorily designed stress tests, you kind of lose sight of what I think is a critical piece, and that is that firms do their own stress tests, their own kind of scenario analysis. What could be particularly problematic for the individual firm, and how do you deal with it? I hope the Fed and others don't go so far down the path of a common stress testing regime, they lose sight of that value.
Simon?
Well, I disagree completely.
Well, answer the original question first, please.
Yeah,
the original question was, are these large institutions more or less of a problem now than before Dodd-Frank? Then you can disagree.
Yeah, Dodd-Frank was helpful in some specific regards, but these large financial institutions are without question much more of a problem, much more of a danger to the economy today than they were in 2007, 2005. Go back to the early 1990s, Tom. The largest 6 financial institutions in the United States had a total balance sheet around 15, 16% of GDP. Now they're 60, 62% of GDP. They've just got larger during both the boom and the crisis. Well, Tom points out that it's smaller than most developed countries. That's true. But if we're comparing, if we're using the European banking system as a benchmark, we're really in trouble. Because they have completely messed up. In fact, I would say that's the cautionary tale.
Canada, and that's my last.
You're thinking of Canada, did you say? No. Okay.
Well,
Australia.
Canada is a wonderful country, and I have nothing bad to say about it. But if you think that the relationship between regulators and bank executives in the United States could be anything like it is in Canada, move to Canada. It's just not going to happen. Bill made a couple of, Tom also made this important point about stress tests. Now, stress tests do have a role to play in and after crises, and Bill also made this point. But relying on stress tests on an annual basis to look for trouble, that's typically a recipe for success. I'm a little surprised to hear Bill endorse that, because usually I hear people with a strong supervisory background like Bill emphasizing, I think correctly, that the right way to approach banking, financial institutions is with careful supervision, the kind you talked about with the specialists who are embedded, who really understand what's going on, who are looking proactively, not doing this rather static calculation that's actually pretty easy to game. Ina Drew, Exhibit 46, was gaming the stress test quite successfully from the point of view of the stress test, because the Fed didn't know what was going on. But this is exactly what's going to happen. Now, the Orderly Liquidation Authority, the so-called Title II Resolution Authority under Dodd-Frank,
which is also the living will, right?
No, living will is Title I. Living will is, how much time do you have, by the way? Now, living will is the requirement that these financial institutions draw up a plan, part of which is public, part of which is private, that would lay out how they could go bankrupt without any kind of government intervention should they face a state of insolvency. And in principle, those living wills can be used by the Fed and other officials to force the banks to become simpler, become smaller, whatever it would do, whatever it would take to be more easily handled through bankruptcy. Nothing has happened, Michael. No consequences. In fact, we have the president of the New York Fed, Bill Dudley, on the record as saying the first round of living wills failed. Oops, let's do it again. Well, how many times are we going to do this? How many makeovers do you get in the Chicago school system? I'm not sure. I know, well, yeah, perhaps we shouldn't go there. Living wills, you can forget it. They're irrelevant. Forget about it. Write them off. Now, Title II, this is the process through which the government would come in the form of the Federal Deposit Insurance Corporation, the FDIC, that does this for banks with insured deposits. It's been doing it since the 1930s. They now have the power to do this for these large, complex global financial institutions. Great. There's a loophole. Doesn't apply to cross-border activities. There is no global resolution authority. You can't write one, you can't legislate one. It's not within the power of the U.S. Congress or any of the U.S. agencies. You need other countries to agree with you to the same mechanism. What are the odds, Tom, that the Europeans will ever agree among themselves on how to resolve banks in a cross-border setting, let alone agree with the UK and with the United States? I would say the probability that you'll see that in your working lifetimes is zero. And if you want a graphic demonstration of how this goes wrong in the European context and can go wrong on a grander scale, remember what happened in Cyprus and the way that was completely screwed up, a technical term in banking language, by the way, screwed up by the Europeans because they have no framework, no agreement, no way of doing it. That's what we're locked into with this Orderly Liquidation Authority when you try to take on a Citigroup or a JP Morgan Chase or a Bank of America or a Goldman Sachs or a Morgan Stanley. Those are inherently and absolutely by design complex cross-border operations. The Orderly Liquidation Authority is not going to help you with cross-border financial failures at that scale.
So isn't the expectation, though, that if one of these institutions gets into trouble, as you said, Thursday is a good day, that the regulator comes in on a Friday, usually, and over the weekend, they use the resolution document or living will, which is a huge document these days, and use that as the basis for breaking up or taking over the firm. They get rid of the management, they wipe out the shareholders, probably the bondholders get wiped out as well, and then they move forward. Isn't that the expectation here?
The FDIC's proposed approach is so-called single point of entry, which means they would take over the holding company of these financial institutions. They all have a holding company. They would wipe out the equity. They would convert the debt to equity. Come back to that in a moment. And they'd use this to recapitalize other parts of the holding company that need more capital. Now, in order to make that work, there needs to be enough. This is what's called a bail-in approach. You're bailing in the debt holders. That debt has to be unsecured for this to work. It has to be held by people, institutions that are not highly leveraged, which cannot experience runs, so you can take money markets completely out of that picture. And it has to be big relative to the losses that these financial institutions face. So how much of this bail-inable capital do we have in our largest bank holding companies? Well, Moody's has a report out that I recommend to you. It's one way to calculate the numbers. They think that JP Morgan Chase has 4% of bail-inable capital relative to total assets. That's it. That's a tiny, tiny cushion to support this kind of approach. And if there isn't enough bail-inable capital, well, then you're actually in exactly the Cyprus situation. They had this problem. There was nobody to bail in. So you're looking at, okay, who's going to pay for this? Some government or uninsured depositors, or in the Cypriot case, of course, they considered forcing losses on uninsured depositors for a week. We would not do that in the United States. We would absolutely not do that. But my point is, where's the Fed? The Federal Reserve has the power, the authority, the right, and the responsibility to determine the amount of bail-inable capital at the holding company level in order to make this order liquidational authority even remotely feasible.
So
there are no rules on this. There's no rules, and there's no indication they're at all going to move this sufficiently in the right direction.
Let's talk about that capital point now, because you've raised it several times. There are certain capital standards, but the way we're now supervising banks since the crisis is the level of capital requirements by regulators, by supervisors, has gone up significantly, hasn't it? I mean, regardless of what the standard was.
It has gone up, although a lot of the Basel agreement is to come. There's a lengthy phase-in process before all of the capital requirements come into place, all the surcharges and buffers come into place. I think the market, probably more than the regulators, has pushed for firms to move up closer to those kinds of ultimate Basel requirements. I do think the stress testing element, and I do obviously give it more weight than Simon does, is useful in getting firms to think through what the adverse implications would be of various kinds of scenarios, and the regulators requiring them not only to hold capital, but hold good capital. And one of the things that we were faced with during the crisis was the way in which the Basel rules were structured. There wasn't a whole lot of focus on the numerator in the capital calculation, and there tended to be a weakening of the capital structure of banking organizations. Not much common equity in some cases, lots of preferred hybrids. That's something that has changed, and I think it's been helped to be reinforced through the several stress testing exercises.
Well, when the financial crisis was breaking, you were there. If firms had more capital, would that have prevented the crisis, or was it a liquidity crisis?
Unequivocally a combination of the two, that there were markets that seized up, there was inability to really fund all the commitments organizations had made. If you look just at nominal capital ratios, in many cases they weren't that bad, but it was the expectation of where they would go. fueled by all the problems in individual funding and liquidity markets that was starting to cause firms to incur losses, but I think much more fundamentally caused the marketplace to lose confidence in the integrity of the financials of the firm over the longer haul, leading to exodus of sometimes very volatile liabilities. So I think it is impossible to just look at the capital side. You need to really focus heavily on the liquidity side.
Well, we could go on quite a bit. You want one more comment, then we'll open up for questions from the floor.
On this issue of capital.
Yeah.
Look, it's very important to remember that much of the focus in the Basel agreements is on risk-weighted capital. So you get, as a bank, to calculate your own risk weights with some input from the officials. What is a low-risk asset in Europe today? For example, just go back to the Europeans. Tom brought them up. Sovereign debt. Sovereign debt is a low or zero risk weight asset in the European banking framework. Well, you could see what the problem is. What were the low risk assets in the run-up to the financial crisis here? Mortgage-backed securities. Remember the AAA versions, even the synthetic derivatives. The risk weight, the one thing you know about risk weights, Michael, is they are always wrong in the crisis. Forget about that. That is a wrong way to think about capital.
That's why you have a crisis.
Well, it's part of it, as Bill said, and Bill talked about the interaction very well. What you want to focus on is the leverage ratio. And thank goodness in the United States, we did not go fully for Basel II. We kept a leverage ratio, we kept a leverage cap, and we looked at equity relative to total assets unadjusted for risk. What's that number now under Basel? What's the minimum amount of equity funding relative to your total balance sheet that you need to have? 3%. 3% equity, 97% debt. Well, is that more than what it was before? Yes, it was zero under Basel II. Yes, so 3% is more than zero. Is it enough? Of course not. Tom Hernig, the now vice chairman of the FDIC, says 10%. Sheila Bair and others, including me, have suggested higher numbers when we talk about bail-inable capital. Jeremiah Norton of the FDIC is pushing for higher numbers. You should think about leverage, forget about the risk weights, think about loss-absorbing equity relative to total assets, and you should want that number to be as high as is politically possible.
Well, you've opened up a whole subject here, but I got to ask you one just little question. If you have leverage ratios at the height you're talking about, what kind of return on equity would these firms have?
Well, that's an interesting question. Of course, depends on how they choose to adjust. But remember, Michael, as investors, you don't just look at the expected return, you think about the risk. And if you have a bigger buffer, more equity, you should expect less risk for the equity and also less risk for the debt. So you're changing the risk-return characteristics.
I understand.
Now, the insiders don't like this because they get paid the upside and don't worry too much about the downside. But from a broader social point of view, we should want these large financial institutions to become safer. And I recommend a very good book by Anat Admati and Martin Hellwig, The Banker's New Clothes, that exactly expands on and explains this point.
Okay, so more capital, lower returns, but safer. That's the...
That would be, I think, anybody's reasonable expectation.
Okay, let's open it up for the floor. So we have a question right here. Can get you a microphone. Please stand up and tell us who you are and ask the question.
Janet Tabacoli at Tabacoli Structured Finance. I want to thank all of you gentlemen for your perspective, but I have a question. My area of expertise is structured finance, collateralized debt obligations, credit derivatives. And before the crisis, I looked at the stress tests, and the problem was the stress tests were wrong, the risk weightings were wrong, and they were wrong because there were phony securitizations, completely misrated, that could only go in one direction, and that was down. And even worse, they were leveraged. And many of them were going to have to come back on bank balance sheets. Now, I said that in real time. I said it early, and it all happened. I went to Jamie Dimon about AIG in August of 2007 and said, they need to take massive losses. They haven't. Here's my question. I've looked at these securitizations. I've been successful in civil litigation and counseling people on how to sue, and they've done it successfully. We've always settled to keep damaging documents out of the public domain. People settle like that for huge amounts of money. Why haven't we seen thousands of criminal indictments for widespread massive fraud in our financial system? The knock-on effect now, it's all spilled over to the sovereigns, where we have no more AAAs there. We have the overrated sovereigns.
So as
we still have a lot of problems. When I'm looking at the balance sheets now, we still have a lot of problems.
Okay, let us wrap up. So as I understand the question...
Why haven't we seen the
Right.
the
Why
indictments?
haven't you seen criminal indictments against those people who had off-balance sheet entities, structured investment vehicles?
No.
Is this what you're talking about?
No. I understand the question.
Maybe you can rephrase it.
Yeah, I'll rephrase it.
Quickly.
Well, first of all, Janet, you were right then and you're right now. And thank you very much for saying the things you said then. I hope people listen to you more now. The specific question is, we think that there was a great deal of fraud or potential fraud in many of these securitizations. We are not learning much about that because there are settlements in which the details are kept private. Why aren't there prosecutions? Why haven't we seen criminal prosecutions? Well, Janet, you know the answer to that very well, which is the Department of Justice has shown no interest at all in taking this forward, and unfortunately other attorney generals have not decided to make this a top priority. I think it's unfortunate, and it reflects, it was a political decision, I believe, by primarily the Obama administration not to push this. It's related to the too big to jail issue, of course, because they're concerned about the impact. Well, that's a term used by Eric Holder. No, I didn't coin that term. Eric Holder, the Attorney General of the United States.
Right.
But they could have also pursued individuals for criminal prosecutions, and it's not clear to me why they didn't do that.
Anyone else want to talk about the criminal prosecution?
My answer is I partly agree with Simon, but I think this is the issue really where there is an uneven playing field, and dealing with some prosecutors and some regulators on the sort of enforcement side, this stuff is complex and it's hard, and there are not enough staff and resources to do it. So I'm not sure I think there is part of it is a decision not to divert every resource of the criminal justice system to prosecuting the financial crisis. But I think part of it is also because that resource just doesn't exist. Okay,
so we have a question right up here in the front. Could I ask you to keep your question short too, please?
I promise I will. There is another too big to fail entity that we haven't talked about tonight, and that is the capital market system. That is too big to fail. It is the basis of capitalism. What you are talking about tonight and what has happened since 2008 has put the system at risk in certain ways. For example, the London whale brought into question the risk management of the banking system. The MF Global failure brought into question the FCM, the financial clearing system. Other systems have been brought into question, and participants in the financial markets, of which there are many here in Chicago, are concerned about these. As you implement Dodd-Frank and other regulations, it's a slow process, we understand. The participants are not necessarily sure what the laws and rules are, but they have to participate anyway. How can you deal with these issues as you are implementing new rules and regulations to fix the problems that we saw in 2008?
So how can you deal with the existing problems as you're putting out new regulations?
Some of them have been caused by the...
Can I comment?
Brian?
Thank you for asking that. You're spot on in terms of the quandary that our market participants find themselves in. And I think it ties into my opening remarks that we're putting markets through a major transformation. We can all talk about what the mess was, and it was very messy, but there's a lot of new law, there's a lot of new rules. Markets need to continue to function. People still need to be able to utilize these instruments as they're trying to comply with new rules and regulations. People are finding themselves now drawn into some definitional requirements that they never experienced before. These are people that did absolutely nothing wrong, but in order to be able to continue doing the business that they've been doing, they're now categorized differently, and they have to adapt to that new categorization. There's new reporting requirements. There's new compliance requirements. There's new capital requirements. Education, education, education. We are out there trying to do our very best, and anyone that is in this area, I think, needs to spend as much time as they can being out there with the public, helping them understand what's changing, how is it changing, how does it impact you, and how can we help expedite that so that we can allow markets to continue to function as it's going through this transition. But there is a great deal of uncertainty.
Okay, just to add a quick point that there is a definite danger of tarring with a very broad brush that institutions who are trying to do the right thing, and to Brian's point, trying to deal with an avalanche of new requirements, tend to be looked at the same way as people who have had much more extensive problems. And I think a corollary to this whole issue is the prospect of more business leaving the regulated sector, and with the incentives that exist, getting pulled into a more unregulated regime. You might not know about problems until they really explode, because you don't have anybody out there making issues on individual cases.
Ladies and gentlemen, I have 10 hands up, and we're out of time. So I apologize. Maybe some of the panelists would be willing to answer questions one-on-one afterwards, but we have to wrap this up. Before we wrap it up, I promised Simon I would say that he has written a book, and it's available in the back corner of the room, and he may even he'll answer questions while he's signing the books. So, but on behalf of the Chicago Council, I want to thank all of the panelists. You've done a great job tonight. We appreciate it very much, and thank you for being such a great audience. Very good.